While politicians debate whether to raise the debt ceiling by another trillion, something far more fundamental has already broken: the mathematical possibility of ever paying it back. Here are the numbers that should terrify you. The United States now carries $36 trillion in federal debt. The interest payment alone hit $1.2 trillion in fiscal year 2024, more than we spend on defense, more than we spend on Medicare. Japan's debt to GDP ratio just crossed 260%. The European Union is financing 73% of its new debt issuance with money it's essentially printing through quantitative programs. This isn't a crisis we're approaching. This is a transition that's already happened. The wealthy figured this out 18 months ago. That's when institutional buying patterns shifted dramatically toward hard assets and out of sovereign bonds. Here's the pattern most people completely miss. Unsustainable debt doesn't get paid back through austerity or growth. It gets restructured through monetary debasement, and the people holding cash and bonds become the involuntary creditors who get wiped out. And if you don't understand the mechanism that's already in motion, you're going to discover your savings were never yours. They were always the collateral for someone else's borrowing. Let me show you exactly how this works, and what the point of no return actually means. Let's start with what you already know. Governments borrow too much, interest rates rise, debt payments eat larger chunks of the budget. Everyone clutches their pearls and talks about fiscal responsibility. The ceiling gets raised, life continues. Except something changed in 2022. For decades, the United States paid between 1% and 2% interest on its debt. Manageable, sustainable, even with mounting principal. But when inflation forced the Federal Reserve to raise rates to 5.3%, the interest cost on existing debt doubled inside 18 months. The Congressional Budget Office projects that by 2034, interest payments will consume $4.1 trillion annually, 24% of all federal revenue just to service debt, not reduce it, not build infrastructure, not fund programs, just to pay the interest on money already spent. Here's what they're not telling you about how this operates. Once interest payments cross a certain threshold of total revenue, historically around 15 to 20%, a doom loop activates. The government must borrow more money just to pay interest on existing borrowing. This new borrowing generates its own interest obligations, which requires more borrowing, which generates more interest. The debt grows exponentially even if the government runs a balanced budget on everything else. We crossed that threshold in 2023. Every dollar of deficit spending now is no longer funding programs. It's funding the interest on past spending. The debt is now self-perpetuating. But here's the layer. Most analysis completely misses. Governments facing this trap have exactly 3 options. Cut spending so dramatically it triggers depression and political suicide. Raise taxes so high it triggers capital flight and economic collapse. Or debase the currency to inflate away the real value of the debt. Guess which option every government in history has chosen? The wealthy saw this coming. In the fourth quarter of 2023, sovereign wealth funds reduced their holdings of U.S. Treasuries by $87 billion, the largest quarterly decline since records began. The Abu Dhabi Investment Authority quietly tripled its allocation to gold and commodities. Norway's government pension fund shifted 12% of its holdings out of bonds and into real assets. They're not betting on default, they're positioning for debasement. Meanwhile, financial advisors are still telling middle-class savers that a 60-40 stocks-to-bonds portfolio is balanced. Balanced for what? For holding the asset class that gets destroyed when governments inflate away their obligations? Here's the irony that should make you laugh grimly. The people who lent the government money through treasury bonds are about to discover they were volunteering to be defrauded. That's not hyperbole. That's the historical precedent every single time. And while you're listening to my video, the US Treasury is issuing another $23 billion in debt this week. The doom loop accelerates, so governments need to debase their currencies. In the past, this meant printing physical money or revaluing the currency downward. Messy, chaotic, obvious to everyone. People could flee to foreign currencies, gold, or offshore accounts. Not this time. This time, they built the infrastructure to control every step of the debasement process before they pulled the trigger. Let me show you exactly what I'm talking about. Central bank digital currencies aren't about innovation or convenience. They're about removing every escape route that existed during previous debt crises. China's digital yuan processed $986 billion in transactions in 2024. The European Central Bank launches its digital euro pilot in the first quarter of 2026. The Bank of England, the Fed, the Bank of Japan, all running parallel programs with identical capabilities. Here's what this technology enables. First, programmable expiration on currency itself. Your digital dollars could have a spend-by date, forcing consumption and preventing savings accumulation. The European Central Bank's technical papers explicitly describe this functionality as a tool to stimulate velocity during economic slowdowns. Second, negative interest rates enforced at the user level. Not just on bank reserves, on your actual account balance. Sweden's Riksbank already tested this. Every month, your digital wallet balance decreases by a percentage set algorithmically. You can't pull out cash because physical currency is being phased out. You can't flee to foreign accounts because capital controls are now just software updates. Third, tiered access based on compliance. The Bank for International Settlements published a working paper in 2023 outlining how CBDCs could integrate with social credit systems and ESG scores to determine spending privileges. This isn't theoretical. China's system already restricts high-speed rail access and property purchases based on social credit scores. The digital yuan integrates this directly into transaction approval. Once built, infrastructure gets used. Always. The capability becomes the policy. Nigeria launched its Naira in 2021. Within 18 months, the government restricted cash withdrawals to $100 per week and made the digital currency mandatory for government workers. When citizens protested, the central bank remotely disabled transaction capabilities for suspicious patterns. The infrastructure that was sold as convenient became the enforcement mechanism for capital controls. India demonetized 86% of its physical currency overnight in 2016, claiming it would fight corruption. The real result? 13 million small businesses closed because they couldn't access working capital. The wealthy, who hold assets, not cash, were completely unaffected. Here's the pattern. First, they digitize the currency for efficiency, then they restrict alternatives for safety, then they program restrictions for stimulus. Before you realize what happened, money has become permission-based, and the government holds the permission slip. The justification is always modernization. The result is always control, and the timing is not coincidental. These systems are being completed right as debt becomes mathematically unpayable and debasement becomes inevitable. They're not building CBDCs to improve your banking experience. They're building them to manage your behavior during the controlled demolition of currency value. This isn't happening someday. The European digital euro pilot begins in 90 days. The Fed's FedNow infrastructure is already operational, waiting for the digital dollar integration. The architecture for programmable debasement is in final testing. The wealthy aren't worried. You know why? Because they've seen this movie before, and they know exactly which assets survive currency debasement. Let me tell you about a man named Bernard Baruch. In 1929, he was one of the richest men in America. When the market crashed, he didn't panic. He'd already moved 80% of his holdings into gold and short-term treasuries 6 months before Black Tuesday. While banks collapsed and fortunes evaporated, Baruch bought assets for pennies on the dollar. By 1933, when Roosevelt devalued the dollar by 41% through gold revaluation, Baruch's purchasing power had actually increased. His secret? He understood that in a debt crisis, the government will always choose to inflate away obligations rather than default explicitly, and he positioned accordingly out-of-debt instruments into hard assets that couldn't be debased. Fast forward to 2008. As Lehman Brothers collapsed, what did Ray Dalio's Bridgewater Associates do? They increased their gold holdings by 340% and moved into inflation-protected securities. While the average investor watched their bond portfolios get destroyed by quantitative easing, Bridgewater posted positive returns. Today, that translates to a very specific set of moves. The characteristics of assets that survive debasement. They can't be printed, they're globally liquid, they have intrinsic utility or scarcity, and they exist outside the banking system. Look at what ultra-high net worth individuals are actually doing right now. Family offices increased their alternative asset allocations to 52% in 2024, according to Goldman Sachs' wealth survey. Alternatives is wealth management code for real estate, commodities, precious metals, and increasingly decentralized assets. MicroStrategy, run by billionaire Michael Saylor, converted its entire corporate treasury into Bitcoin, now holding over 390,000 coins worth more than $38 billion. Not as speculation, as a structural bet against currency stability. The contrast is staggering. Institutional investors hold an average of 4.7% in cash equivalents. Retail investors hold an average of 23%. The people who understand monetary dynamics hold assets. The people who don't hold currency that's being systematically devalued. You're holding the thing being measured while they're holding the ruler. And they're changing the length of the inches. During the 1920s Weimar hyperinflation, German landowners and factory owners survived. Why? Because property and productive assets retained real value even as the paper mark became worthless. The people destroyed were the ones holding bonds, savings accounts, and fixed pensions, all denominated in currency that went from 4 marks per dollar to 4 trillion marks per dollar in 5 years. The wealthy aren't smarter. They're just playing a completely different game. They're optimizing for purchasing power preservation across currency regimes. You're optimizing for nominal returns within a currency regime that's being actively destroyed. And the window to switch games is narrowing. Every month, more assets become digitized, more capital controls get normalized, more alternative options get regulated into inaccessibility. Here's the timeline that should focus your attention. By the second quarter of 2026, the European digital euro goes live for consumer transactions. By the end of 2026, the Fed will complete its technical assessment of a digital dollar and likely announce pilot programs. By 2027, at least 40 countries representing 60% of global GDP will have operational CBDCs with programmable restrictions. While this infrastructure completes, the debt doom loop accelerates. U.S. interest payments will hit $1.6 trillion annually by 2026. Japan's debt service will consume 42% of tax revenue. The mathematical endpoint, where interest payments exceed all other spending, is now measured in years, not decades. This gives you a specific window, not to escape consequences entirely, but to position yourself on the asset side rather than the liability side of the great restructuring. Let me be clear about what's still possible and what's not. You're not going to beat the system or find some loophole that protects you completely. The system is too large and the mechanism's too comprehensive. But you can absolutely avoid being the primary victim of the mechanism. Here's what that looks like at different scales. If you're starting with limited capital, $5,000 to $20,000, the priority is getting out of pure cash positions and into assets with real-world utility. Physical gold and silver coins you can hold outside the banking system. Tools, equipment, and skills that have barter value if monetary systems fracture. Cryptocurrency holdings on self-custody wallets, not exchange accounts that can be frozen or restricted. If you're working with substantial savings, $50,000 to $500,000, you need to think about jurisdictional diversification, not just asset diversification. Foreign real estate in countries with different currency regimes. Offshore accounts in jurisdictions that haven't implemented CBDCs or capital controls. Commodity-linked investments that track real things rather than financial abstractions. If you have significant wealth, millions, the strategy is building parallel infrastructure entirely outside debt-based systems. Direct ownership of productive assets, farmland, energy production, manufacturing facilities, citizenship or residency in multiple countries providing optionality, allocation to assets specifically designed to be uncorrelated with debt-based currencies. Notice what all these strategies share. They move value away from government-controlled digital systems and into assets that maintain utility regardless of currency manipulation. But let's be honest about the limitations. Capital controls, once implemented, are very difficult to circumvent legally. If your wealth is entirely digital and entirely domestic when restrictions activate, your options will be severely limited. The moves need to happen before the architecture goes fully operational, not after. And there's a psychological component most people underestimate. When everyone around you is losing purchasing power slowly, it will feel safer to stay in the herd than to position differently. The social pressure to be reasonable and not overreact will be intense, right up until the moment restrictions activate and suddenly everyone understands what happened. The Depression survivors who maintained wealth didn't wait until bank runs started. They positioned beforehand, looked paranoid for a while, and then looked prescient. The 2008 survivors who protected assets didn't wait until Lehman collapsed. They saw the housing debt bubble, understood the mechanism, and moved early. The pattern is always the same. The window for preparation is longer than you expect, but the moment of transition is faster than you can react to in real time. Zoom out for a moment and see the full picture. We're watching the final act of a debt-based monetary system that worked for 70 years but has now reached mathematical collapse. The response is not a reset button that fixes the system. The response is a controlled demolition where currency gets debased, assets get protected for those who understand, and purchasing power gets extracted from those who don't. This isn't conspiracy. This is documented policy being implemented in real time by central banks worldwide. The infrastructure is being built in the open. The timeline is public. The capability has been clearly stated. I'm not predicting this will happen. I'm showing you what's already being built and explaining what that infrastructure enables. The question is not whether governments will use debasement to escape debt traps. They always do. The question is whether you'll position accordingly before the options narrow. In the next 18 months, the European digital euro launches. The Fed completes its digital dollar assessment. China expands digital yuan integration across Belt and Road countries. Capital controls that currently exist only in crisis economies will become normalized features of developed market infrastructure. The wealthy positioned already. In 2023 and 2024, institutional money moved dramatically out of sovereign bonds and into hard assets. Not because they predicted a specific date of collapse, because they understood the mechanism and acted while options remained available. You're sitting at the same decision point that Depression-era savers faced in 1928, that Weimar citizens faced in 1922, that anyone facing currency debasement has faced throughout history. 3 paths: accept the debasement and watch your purchasing power evaporate slowly through inflation and account restrictions. Prepare by moving wealth into assets that survive currency manipulation, or resist by building parallel systems and accepting the friction of existing outside conventional finance. But here's what you can't do. Pretend this isn't happening. The math is public. The infrastructure is visible. The timeline is active. The debt bubble is past the point of no return. The only question remaining is whether you are too. If this connected dots you hadn't seen connected, debt dynamics, CBDC infrastructure, and wealth positioning strategies operating simultaneously, then subscribe. Because the patterns emerging now determine whether you're on the asset side or the liability side when this transition fully unfolds. Every week I break down mechanisms most people miss and show you how to position before windows close. See you in the next one.